Hi everyone, 𝗖𝗣𝗶 Biniaz here with CPI Capital. I'm joined by 𝗖𝗣𝗶 Benesocky. Welcome, Eva.
Thank you. Thank you.
We host the CPI Academy YouTube show dedicated to adding value to our viewers' investment journey. We bring on experts and discuss all topics related to real estate investing. Please subscribe and like the video because that will get us traction. We hope you enjoy the video.
Wonderful. Thank you so much, August. Today we're excited because we're joined by our Asset Acquisition Director, Mark Joseph. So welcome, Mark.
Welcome, Mark.
Thanks for having me on.
Wonderful. Well, Mark, let's just dive right into things. Why don't you go ahead and tell everybody about your background, please?
Yeah, a little background about me. Born in Dallas, grew up in Austin. Started off as an engineer. Being South Indian, my dad gave me two choices when I was a kid. He said he could be a doctor or an engineer. I was good at math and science, so I went the engineer route. Was always really fascinated by real estate. Didn't know how to get into it. No one in my family was in real estate. So I got a job at a refinery down outside of Houston and saved every penny I had and started buying some rental properties out there, some duplexes, fourplexes, townhomes. Thought this is really fun. Want to do it full time. Didn't think any company would take me seriously unless I really showed a transition out of the oil and gas space. So I quit my job, came up to Dallas, got an MBA from SMU and sort of started my real estate journey there. Small family private equity office, B and C class multifamily all across the US. Then transitioned to a larger shop, institutional money. Realized I wasn't a great fit at institutional, didn't like the bureaucracies. Then went to a property management shop, all B and C class multifamily, where I was the asset manager for about 7,000 units. Managing business plans, acquisitions, dispositions, everything like that. And then from there, went to another private equity shop that was vertically integrated and left that. And now sort of just taking a little time off, spending time with my wife before I jump back into the full-time game again.
Nice. Great big background and transition. And it's great to hear. I mean, a lot of Eastern cultures, that's the case. You're either good at math, so you can become an engineer, or you're good at science and you become a doctor. So it's funny you brought that up. It seems to be this as kind of the same concept in a lot of Eastern cultures. But now let's talk about the being good at math, because this space of kind of syndicated investments or multifamily or commercial real estate, there is a component which is very much math related, and that is the analytics, the deal analyzing. And is that the kind of with your background, engineering background, is that a component where you spend most of your time or did most of your advising on?
Yeah, I would say in terms of the real estate math, it's fairly simplistic. I mean, I would say it's more understanding different nuances of a deal geographically, or even that particular deal itself. But yeah, I spend most of my time in the numbers. I mean, I love the numbers, obviously.
He just brushes it off.
I know.
So just to let everyone know, Mark is our asset acquisition director. So one of his duties is to underwrite deals as they come in, and we see it as very complex. So we actually went through a training course. It wasn't really a course, but it was more on Zoom, getting educated on how to underwrite a deal, and Mark did that for us. And it is pretty complex. And aside from actual kind of the regions to go into or any kind of property management or the business side of it, when it comes to analytics and analyzing a deal, talk to us about what is a deal analyzer and how that deal analyzer, the calculator per se, gets connected with multifamily or commercial real estate investing.
Yeah, so deal analyzer, like the one that we've been working on with y'all. I mean, it just takes simplistically it sounds simplistic, but you're right. It is pretty complex on the back end. So it's going to take your operating data for whatever property you're looking at, and basically turn it into a model with whatever inputs and variables you put in there. In terms of income growth, what type of renovations, capital, and what kind of rents you think you can get to. So in a long story short, it's going to tell you if this deal is investable or not from what metrics you're looking for in terms of a waterfall and things like that.
That's incredible. Now, I was going to quickly just jump in for a second. How many deals do you think, what's the percentage on when you underwrite a deal and then people move forward on that deal? how many deals do you think go up through the underwriting process that actually end up going through the full cycle where they purchase the property? Or when did they
Yes.
fall off?
So I would say 8 years ago, probably a higher percentage from their initial triage of a deal to maybe fully underwriting a deal. Now with cap rates being so highly compressed and just the state of the market, I would say a handful. I underwrite quite a few deals, but maybe only a handful of them over the year may actually go through full underwriting. And that's for a myriad of reasons, mostly just what the particular client or, in my case, what my owners are looking for in terms of returns. It just doesn't meet it. I'm not saying a deal is bad. It just doesn't meet your return metrics.
Exactly, and if it does, also in this case, if it does meets the the returns that the operator is looking at, they might not get awarded the deal because it's so competitive. So then that's also kind of another item I wanted to add in there. So now let's focus on underwriting. So you talked about doing a full underwriting. So I guess there is also a brief version of that. So kind of walk our viewers through as if a deal comes through. So August and Ava, CPI Capital has a deal that comes across our has come across our desk. Let's say the deal is on market by a well-known marketing team or a sales team, and there's a lot of data associated with, for example, the rent rolls and many other information. Now, when that deal comes in, what is the first kind of the brief underwriting, or what is the kind of correct term of putting that? What is the first kind of the first step that you take?
Yeah, the first step I take before throwing a broker's OM out the door is looking at what T12 NOI they're showing and divide that by the purchase price, which you think you may get it at. And that just kind of gives me a sense of where it could trade at. I mean, obviously, like you said, these deals are going to best and final and sometimes trading for much higher than what you initially thought. So that's the first step. I just see, hey, what cap rate is this? Does this even make sense from a cap rate perspective? And then sort of initially, along with that first step, I call it kind of 1A. I'll look at like a T12 and a rent roll and see where things are trending. Because sometimes, you might have some a little bit of variation and some noise in the T12 that maybe, hey, I didn't realize that I can take that out and it may make the numbers look better, but also, there may be things that they're not accounting for on just like a snapshot T12 NOI that I can see on a month-over-month basis.
Got it. So now again, let's kind of walk it through. So
yep.
The numbers come in. You've had that kind of brief overview. You've tested to see if the deal makes sense. And this is kind of aside from. In the past we've had conversation when a deal has come through to us that, hey, it's in a market where there isn't significant job growth or population growth. That in 5 years when we want to exit the asset, we might, as far as appreciation, be around the same place we are today. But let's say it checks off all of that kind of market and population growth, job growth, income growth. Now you looked at the numbers, the NOI, the rent roll, the cap rates, and it checks off many of the items you're looking at. Walk us through what a full-on underwriting entails, if you may.
Yeah, so you're going to build everything off the T12, and then also your assumptions on what you think you can get on the upside in terms of rents on a true value add deal. The T12 things will adjust for as taxes based on the local jurisdiction, how they appraise taxes. Is it on purchase? Is it just like on some time period? And then we'll adjust other things like vacancy. This property may be operating at a huge vacancy or a higher loss to lease. And based on what we think we can operate it at, we'll adjust those. So that's kind of the initial adjustment on that. And then we'll look at like kind of the units. Okay, hey, our business plan, we want to upgrade 50% of these units and spend X amount of dollars. But we think we can get like let's say a $200 rent bump. So we'll kind of phase those in over the life of the business plan, let's say the first 2 years, and then kind of see what our terminal NOI is with the adjusted cap rate, what we think it could be in 3 to 5 years. And then kind of working back, we say, okay, hey, what price are we willing to pay in order to get this value on the back end? So that's kind of the method we use when we're looking at a deal.
Sounds simplistic. No,
So,
not at all.
not at all. So is it fair to say commercial real estate is, rather than buying real estate, it seems like you're buying a business, because that income and the expense is such an important component of underwriting a deal.
Yeah, you're definitely. I always like to call it you're buying a business made up of a bunch of people. You're having a bunch of people, because at the end of the day, you're here to serve your tenants, and without them, you couldn't get the numbers or the business numbers that you want. But yeah, you're right. You're buying a business of just cash flow. The real estate is, ultimately valued on its cash flow.
Great point. And just kind of compare it. Sorry,
Please,
Ava, I'm so excited to have Mark.
Yes,
just to kind of compare commercial real estate, especially when it comes to multifamily, and we'll get into the value add component of it as well. But when you're comparing that with single family or a smaller project, the numbers are very simple in single family. You have your land. I'm talking about single family development, or even a fix and flip. You have the land price or the asset price, you have the construction cost or renovation cost, and then you have your sales cost, which the market kind of shows you when you're starting to do the deal. So those are three main components and numbers you're looking at. But when you're talking about multifamily, now it's much more kind of much more data coming in. You have the income that a property is currently producing, the income that a property can be producing depending on the upgrades that are done. Then you have, taxes. That's another item that you mentioned. The difference between the US and Canada, I believe, is taxes are assessed on a property at a time of sale. So if the property that was sold 10 years ago for $1 million, they're being taxed at that million. But when a sale takes place and that same property is sold now for 100 million, that tax has changed. So that needs to kind of be allocated in the item. So you got you got the income, you got the expense, you got the tenant ratio, you got the taxes, you got renovations that need to go in, but also you have you talked about waterfall. So that is the investors. A lot of times these these investments, these larger multifamily investments are syndicated. That means there's capital raised from investors. And that is also part of your calculation that you need to add in to see what are the returns going back to the investors. So if you'd like to kind of touch on that and highlight that aspect of it.
Yeah, you hit on it, like a residential space, it's a lot less variables involved, and you're not really buying a house for let's say a development for the cash flow it produces. It's more of what the value is compared to other houses. You're not looking at it like from a down the line, hey, what is this going to be worth? You care about now. Whereas real estate, commercial real estate, you're not really, in terms of the value add space, you're not really buying it for what it is now. You're buying it for what it can be down the line. So that's like an added layer of complexity with all these different variables and levers that you can pull. Some of them you can control, some of them you can't. In terms of taxes, you can't really control that, but some of them you can in terms of your renovation plan, the income, tightening up on expenses. Some of it's a bit of luck in terms of timing, like we're seeing now. Like a lot of these sellers are just making a boatload of money because of cap rate compression, but there's a lot of elements to it that you can control and sort of push out what your value can be based on those, versus like a single family, which is you're very limited on what other things sell for currently.
Yes, very true. Very true. So now with us, CPI Capital is a Canadian firm that partners with Canadian investors to acquire US multifamily. So, in this space, I mean, we've aligned our partnership with many key, consultants, and one of them in our underwriting department is yourself. Now, what I've noticed in the past, when I send you emails or a deal that comes across our desk, you, in a way, you play a role of a detective. You have certain information that's coming to you, and you kind of dissect that information and figure out if it makes sense or not. So talk to us about red flags that you've seen in the past, or any items that has kind of maybe it's either the broker or the seller that are either omitting or there might be, doctoring to get better results. Talk to us about those kind of red flags that you look out for and items you've seen in the past.
Great question.
Yeah, for sure. So some of the things I look for is what is the breakdown of 1 bedrooms versus 2 bedrooms in a property, especially like an older property. Just from my experience, pushing rents on a 1 bedroom, especially when they're smaller, is pretty difficult. So that's a big red flag for me in terms of like upward rent growth on a 1 bedroom unit if you're going to renovate. Another sort of red flag is just overall just cost. I sometimes, look at some of these on a dollar per square foot and unit cost, and obviously with the price of lumber, replacement cost is going up. But sometimes I just do a little sanity check on that end, and then on terms of like the broker package, some things to look out for that I see is they'll have a pro forma with water savings on it, but then also give you credit for like income and reducing expense. So almost in a way like double counting that. So there's some interesting ways that they're trying to bump up income, but I don't really look at their pro forma much because I know they're trying to sell something. It doesn't really matter as much, but those are just some things to keep an eye out on. I think the biggest, especially on the value, is in my opinion, is the size of the units and the mix of the 1 and 2 bedrooms.
Mix of the 1 and 2 bedrooms. And yeah, so I mean, there's also another kind of item that comes to mind is exit cap rates. Could you explain what a cap rate is, and what does an exit cap rate have to do with an entry cap rate? Because that's kind of the number that it's an unknown number, but it's a very significant amount depending on what the exit cap rate is. The deal either economically makes sense or not.
Yeah, so cap rate, just the math on it, is your net operating income divided by your purchase price. Now, what that means is it's sort of a level of return you can say you'd expect for this deal. So if you bought a deal all cash and it's a 5 cap and you paid $1 million for that, you should expect $50,000 of cash per year. So I look at it almost like a level of risk, especially in like a value add space. Like if I'm going to buy a 1980s deal for a 3.5 cap, I hope that on my pro forma that I can get to like a 6 or a 5.5 or 6, like significantly increase that cap rate in terms of actual operating. Now, in terms of an exit cap, that's really hard to say, especially in this market. And I think you guys do a great job of like identifying markets with good job growth, geographic locations that, hey, look, they're less likely to see a significant increase in cap rate. So I applaud y'all for like really sticking to your investment thesis on that, because sometimes I look at deals just based on yield, but those are a lot more risky deals than investing in the markets that you guys go after.
Yes, and for us, I mean, just to touch on that, for CPI, capital preservation is on top of our list of what we're trying to achieve. We are somewhat of a newer firm, and we're partnering with Canadians to kind of bring them these great opportunities that exist across the border. So that kind of capital preservation and the safe investment is a very important part. So we want to be as conservative as possible when it comes to deals. But great. So now, multifamily value add in the commercial real estate space. There are commercial kind of mixed use, industrial. There's land. There's so many different kind of asset classes within that space. But this value add multifamily, and you talked about kind of the 80s. Talk to us about what are the benefits of the value add when an operator like us purchases the asset and does certain renovations. Talk to us about that component, if you may.
Yeah, in theory, like, your value add, you're purchasing a property that has some sort of rent delta based on, finish out of unit or exterior, where you can come and inject some capital in the interiors and exteriors and also get a return on that money you spend in terms of like an actual cash flow. But then when you think of it, you get a multiple return when you think of it in terms of the cap rate. So that cash flow, and let's say it's $200 you're getting. annualize that $2,400, take some sort of expense ratio. It's not going to be 50% because incremental more dollars doesn't cost you more in expense. And then cap that at like, whatever you think your exit cap is. So, let's say $2,000 on one unit for a year at a 5 cap, that's $40,000 in value you just created just by bumping it up by $200 on that one unit. Now multiply that out by 200 units. That's the kind of great thing about this value add space. Now, the prices are getting a little high. So sometimes the price you're paying initially, you have to spend the money in order to justify the price. But in theory, that's how a value add, especially when I'm referencing in 1980s. Now there's different types of value add. There's newer value add too, 90s, 2000 products that can be taken to sort of a plus class finish out.
Yes. And I think it was earlier in our process. It was when we saw the underwriting or the performa on a deal, and we noticed that like a 200 unit apartment building, and the rents were being increased by $50. And that kind of increased the asset value by millions of dollars. Could you explain that to some viewers who might not be experienced? I think you just touched on it a bit, but if you can.
Yeah. So the way you look at it, and this is just saying I'm saying there's no incremental expense associated with that in terms of operating expense, because there's not really on just, bumping up the rent. So let's say that's 200 unit property, like you mentioned, and you can get $50 across the board. So 200 times 50 is $10,000. That right? Yeah, $10,000. And then for 12 months, you annualize that, $120,000.
Yes.
Now, whatever cap rate it's trading in that market, let's say a 5 cap, like I was, just to make it easy. So multiply that 120,000 by 20, and you just created $2.4 million of value on that property.
That's incredible.
That is incredible. It's just straight math.
It's just straight math, yeah.
But it's incredible. I mean, sometimes we have to kind of explain that to investors of the value add model and why it's so great, because we get to kind of buy an asset because it's purchased in the right area where we're enjoying the natural appreciation that asset has, but then we're also going in and force appreciating it by doing some small renovations so we can ask for higher rents for those units. And that higher rent is that's the difficulty a lot of investors have is, hey, how can $50 in rent per unit increase an asset value by millions? But
you do the numbers.
You touched on that.
Yeah.
No, we were wondering, do you have capability of sharing your screen by any chance?
Yeah.
If you could, and if you could share what a deal analyzer looks like
yeah.
and just on a kind of high level, if you can go over, what are the
exciting numbers that we go through to find out if a deal
and as long as the broker
not.
And the sales team provides to us all the information we need, because a lot of time a deal could be dead because we're not getting the information we're asking for. Yes. But let's say that all the information has come in, and now you enter that information into this deal analyzer, and
okay, yeah. Can I share?
You can see if the numbers. Can you make him the host?
Yeah, possibly? I'm gonna possibly make you the co-host, right? Make him.
Let's see.
There you go. So try to share.
Let's do this. So this is it says apartment name on there, I apologize, but this is a deal analyzer that I was working on for y'all. So, this is sort of the inputs page. You can see obviously like purchase price, going in NOI, going in cap rate, and some of the return metrics on this one. Obviously this deal wasn't one that you decided to pursue based on some of the return metrics. And then sort of on here is sort of that value add component that we talked about, like based on some of the rent bumps. Hey, you're taking this property from 63 million up to 81 million just based on some of the cash flow. And in fact, your exit cap rate, if you see, is 5 versus you're going in at 4. So, I mean, that's also a better assumption than continuing to suggest that cap rates are going to continue to compress.
Yes. Just to stay on that page for a quick moment, just kind of update on this deal. This was a deal that we did put an offer in. So the information came out on this deal today, and this project was sold at $73 million. So now, now, when you're looking at this from an investor perspective, is important that the operator or the general partner you're aligning yourself with has the best interest of the investor. Not saying that whoever bought it for 73, what their business model was, but for us, the numbers that made the most sense was at this around the $64 million mark, and anything above that wasn't economically viable for us. But another team comes in and spends an extra $10 million. Now their whole time might be much longer than what our plan was, but economically that didn't make sense to us or our investors. So just want to kind of give an update about this deal.
Yeah. And then, exactly. I think if you even sometimes $100,000 on this deal can make or break a deal in a lot of cases. So, some of the other inputs, that we've been working on with you guys is, what type, obviously debt, your hold period, 5 years, exit, cap rate assumptions. You'll see some other metrics, loan start date, loan end date, how many years of interest only you can get. We've, it's still a work in progress, but we've tried to create this out so it's functional for you guys to use, and also easy to use, so it doesn't take a day to turn around on this. So you can just input a lot of this data. So some of the other stuff you'll see in here is like sources and uses. I think on this one we assumed about $2.5 million of capex. So if you're going back to that, if you think about $73 million purchase, and you're still going to put in $2.5 million of capex plus some of your other closing costs, I mean, it could be, it's tight. It's tight on that, on according to this model. So
they basically went in at what we were planning to get out 5 years from now after the value add, but yeah,
which I think is wild. I see that all the time. Like, people are paying the price, like future price, and they still have to do the renovation just to justify that purchase. Sometimes it doesn't make sense to me, but that's probably why I'm not really a GP. Yeah, and here's some of like the growth, this is where we build off like your T12. In this case, if you look at this line, we use like a T3 income, T12 expenses, and have some different growth assumptions on income and expenses.
And T12 is
the trailing 12 months.
For the past 12 months of rental income or any kind
income and expenses. Yeah, that's right.
Income and expenses. Okay.
Yeah. Excuse me. And then we also, have different sort of financing assumptions, amortization. In this case, it was a few years of IO. So you're just going to make interest payments, which, help cash flow and also help your business plan when, you're renovating your property. You want to be burdened with, some principal payments. As you can see down here, once this particular deal started amortizing, it's another $70,000 a month of mortgage payment. And then kind of here, the meat of it, which really justifies or doesn't justify an acquisition, is your renovation plan. So I think on this one, we said you could potentially get $189 by spending about $11,000 in each unit. And we're going to renovate about 50% of the units. So that's what sort of got to our back end NOI.
And just quickly going over that. So 11,000 for 50 units, was it?
Yes.
So 11,000.
50% of the units, yeah.
50% of the units. So that's that was around 175 units, let's say, at 11,000. But then what would the appreciation be there? I just wanted to put the kind of ratio of what would our expense be at for the renovation, and now how much appreciation have we forced by doing that?
Yeah, let me.
I'm not sure if it's easy for you to do that.
You're gonna put him to work right now.
No, you're good. It'll take a sec. So, so the quick math is you take that 11,100 times 176 units.
Yes.
Sorry, my computer's freezing up on here. And then sort of the same calculation we talked about earlier. You take your $189 on the 176 units times 12. You can probably do like, I don't know, like 80% of that you get, 20% goes to expenses. And then you cap that at a 5 cap in this case. And I'm sorry, I'm having some computer difficulties, but
No worries.
I'll stop sharing. But yeah, so it's the same math on there. So you really want to see, like, I look at it like there's probably value add in a lot of deals, but you want to see a good spread between your purchase price plus your CapEx and then your exit, so that you can return some money. Because if you're buying at 50, but then the exit's at 50 as well, and you have to spend 5, it doesn't make sense. So you want a good spread between what you think you can get on the back end and what you're buying on the front end, which is somewhat hard to find right now, but
got it.
Kind of the market.
And now, as far as
explanation.
being in the multifamily value add space, where we buy already existing structures and we cash flowing in most cases, and we add certain values by doing renovations. Now, the lumber cost has gone up, so the replacement cost for an asset has gone up. So new construction, of course, the construction cost has gone up. How does that relate to the multifamily value add space? Is the lumber price going up better for this space, or is it worse? Does it relate to, because in value add, you're not really using a lot of lumber. It's more new construction where there's a lot of lumber that's being used. So the higher lumber costs and higher other costs kind of make or break a deal. How about in the value add space?
Yeah, I'm not sure the exact correlation of it. I know just overall, I would think, it's probably a different buyer in the new ground up construction versus the value add space. But there's probably some correlation, like, somebody who may have considered buying is like, hey, I'd rather just go park my money over here versus taking the risk on the lumber cost. But I'm not exactly sure how that would tie between new construction and value add.
Yeah, because we noticed as the cap rates were getting compressed and it was being much more competitive, some sponsors started focusing on doing new build constructions. But now with the higher lumber costs and other material costs and even labor costs rising, does it make sense to focus on new build or still the value add model, which is a very competitive kind of space? So that's the reason I brought that up.
Okay.
And Mark, maybe you can share a couple projects that you're working on right now. I'm curious.
Yeah, I'm not really working on anything right now. I'm spending
you're spending some time with your wife and taking.
Yeah, she does some like design work on houses, and then I'm just taking a little bit of time off before I jump back into the full-time game. But stuff I was looking at, just more on the yield side. I'm pretty conservative by nature, which probably is good and bad. I learned my first boss was very conservative. Always look for current yield, cash flow, and never assumed any back end appreciation. So, I'm looking at stuff in secondary, tertiary markets that have like a double-digit cash on cash return day one.
Okay.
When I do look at things, but I love looking at the primary markets as well with y'all.
Absolutely, yeah. We'd love to send you deals. Awesome. So if you want to.
Well, the question that I like to ask all of our guests is, what would be your number one advice to a passive investor or someone that's looking to start passively investing in real estate?
I would say learn as much as you can about real estate in general. So you're familiar with some of the terms, and you can, if you don't have the background on it, it's hard to vet a deal. So you got to have just like the background on whatever asset class or space you're investing in. And that's just sort of life in general. If you want to invest in stocks, it's better to learn about stocks instead of just taking someone's word for it. That's the number one advice. And then also speak to a lot of people, not just the deal sponsors, but other people who've been in the real estate field, maybe in that particular space. And then vet the sponsor. I think, I'd rather invest with people I trust and like versus people I don't. Yeah. I think those are kind of like high level what I would look for in terms of like if you're just starting out to invest.
Great advice. Great advice. Really appreciate it.
And Mark, thank you for being our numbers guy.
You're welcome.
So good at what you do.
We really appreciate it. As are also underwriting gurus that somebody we come to ask advice for, and I literally get kind of educated. So really appreciate your time. Thanks for coming on today. We'll share all your contact information. So if anybody else wants to kind of reach out to you, any other sponsors or any other groups, we've had an incredible experience with you. We love to also bring you on as more and more deals come through CPI, and we'll kind of our viewers will see a lot more of your face as time goes.
All right.
And they can learn the numbers of how we underwrite our deals.
Awesome.
No, I love it. I love teaching, so I love helping, and I'm excited to see where y'all go.
You're the best. Thanks, Mark. Thank you.
Thanks.